It's time now for today's strategy session. The bond market's safe haven status coming into question, with 30-year yields surging 60 basis points from last week's low. As the long end of the yield curve continues to rise, what is the signal that bond investors are telling us? Here with more, we've got George Bory. He's the chief investment strategist for fixed income at Allspring Global Investments. George, great to speak with you. A therapist might say that the bond market is putting forward an emotional call right now. What does the bond market want us to understand? What's it signaling?
Yeah, well, I think, good morning and thanks for having me on the show. Really appreciate it. I mean, the bond market, similar to the equity market, is in the process of digesting the changes in tariffs. And there's a combination of, initially there was just fears of growth and growth slowdown, and we saw bond yields rally, bond prices go up, yields down. But since then, we've had some thoughts about potential inflationary impulses likely to come through over the next several months. And importantly, the Treasury needs to finance itself with considerable amounts of debt issuance, which leads the market to some levels of vulnerability. Whenever we have an auction week like we're seeing now, we tend to see bond yields sell off, and that's in anticipation of new issuance. And so there's an element of that sort of working its way through the system. Plus, bond investors want a bigger term premium. Now, that's a fancy way of saying they want to earn a little bit more out at the long end, simply because there is this big question mark as to how tariffs are going to work their way through the system. They may ultimately be inflationary. And so bond investors need some extra premium to sort of offset that. So it's a combination of, sort of market recalibration, some very rational sort of fears, if you will, about inflation for bond investors. And then there's this technical uncertainty as the Treasury does need to issue considerable amounts of debt, not just today, but in the coming weeks and months.
So what side of duration is safest to play when you have an unclear trade war that's continuing to ratchet higher?
That's a very good point. We think that, holding treasuries and having some duration in your portfolio is really important. Bonds are the steady cash flows that come from bonds are very powerful. And so, what we're telling investors is have some duration in your portfolio. In and around the 5-year part of the curve is fairly attractive, but we can go out a little bit further. And in that environment, sort of that bonds provide certainty in an uncertain world. They're contracts. And so you want that consistent cash flow coming to you as you move through time. Now, the yield curve itself is steepening pretty dramatically. As I just mentioned, the very long end of the curve is pricing in this uncertainty as it relates to inflation. And at some point that will, sort of reflect, it will be fully priced. It's hard to say that that's fully priced today. So we're still cautious on the very long end of the curve. But that sort of intermediate part of the curve in and around the 5-year plus or minus a couple of years, makes a lot of sense to us, because you do benefit from downside protection. If the economy does slide into a recession, you would expect those bond yields to be fairly well anchored. They're also connected to the Fed. And while the Fed has said they want to stay on hold for the time being, to the extent you get economic weakness, the Fed would likely cut rates, and that would bring those yields down and help boost those prices. So there are opportunities on the yield curve to sort of position yourself to benefit in this kind of environment.
Since you bring up the Fed, I want to talk to you about the probability of a rate cut. Right now, we're looking at about a 55% probability of a rate cut on May 7th. That's obviously been coming down. Is that the bond market and investors indicating to us that the Fed cannot control what's happening in this market, that even if they did cut, it's not going to matter? It's not going to put the tariff genie back in the bottle?
I think that's a great point. The Fed is in more reactionary mode rather than proactionary mode. In the past, when we have sort of a shock to the system, the Fed usually is in a place to be able to just simply try and reflate the economy in the hopes of offsetting, whatever shock has kind of hit the economy. This is very different. The federal government, is changing the tariff policy as it relates to trade. And so the Federal Reserve is not really in a position to sort of simply push back against that. So the Fed's job is really to sort of keep an orderly financial market and then respond to the economic consequences that result from different policy changes. And we don't know exactly how this will filter through the economy. And Fed Chairman Powell mentioned that at the end of last week. The probability of a recession's gone up and the possibility of inflation has gone up, but it hasn't happened yet. So they're in reaction mode. They're not in proactive mode. And I think that's a very important distinction in prior, sort of shocks when we see major dramatic spikes in volatility.
Yeah, that data dependency will have them in reaction mode for quite some time here, George, from what we can gather upon what they've continued to say and signal to the street. George, thanks so much for taking the time here with us this morning.
Thank you.